we good? Welcome back to the Russell Journal. My name is Russell, and this is my journal entry for Tuesday, December 27th, 2022. Sorry, we're running late today. I had some computer issues. I apologize for that. But here we are now. We're getting going, and today gonna definitely go over some of the reviews for. I'm gonna talk a lot more in depth about how I lost $1,000, what happened, what I learned, what I'm gonna do differently. Basically, in the market today, not a lot of economic data, not much coming out throughout the end of the year. So there's not really much to discuss. We did have some stuff with Russia possibly wanting to end the war in Ukraine, and we did have some stuff with China, potential open up and stuff like that. But we haven't seen any sort of fruit as far as that's concerned. And I'm trying actually very hard. If you caught yesterday's show, one of the things I talked about was not letting the news bias you for or against your trades. And so there's a bit of me that's sort of trying to be aware of news and news catalysts, but I am trying to like step back and not focus so much on trading the news. Really focusing more on letting the charts, the price action, momentum, and my indicators sort of dictate my behavior within it. As far as I can tell, we're still in the same spot we really were. We didn't sell off of it. We had kind of little bit of a big swing down, big swing back up, then kind of ended pretty close to the lower third of the range. So overall, it was a little bit of a turbulent day, but not as much as you would really hope for if you're really trying to make a lot of money. If you did do well today, congratulations. Anyway, so getting into it. About 2 months ago, I put $1,000 in my account, and over the course of November, basically, I lost the whole $1,000. Which is pretty rough considering the fact that I didn't actually lose $1,000. I actually lost more like $1,500 because starting off I was up almost $500 right away, and over the course of that month I basically lost the whole $1,500. And so the question is, what did I do? How was I trading? What was I working on? Okay, so the very first thing that I did to get that money was to get the $500 win that I was in, is I began playing with what's called a straddle, okay? Now, so let me explain to you what a straddle is, if you don't know, and how it's supposed to work properly. And then from there, we will actually break down what I did, and you will see why it didn't work. So a straddle is an option strategy where you go long and short at the same time at the same price, okay? You're straddling a price. So, for example, if a stock is trading at $100, you will buy the call with a $100 strike, and you will buy the put with a $100 strike. Now, this is not the only form of straddle on there. There's long straddles, short straddles. There's other things that you can do. You can sell straddles, right? So things of that nature that you can do differently, but with what I do and the way I trade, I'm only buying contracts, especially with a small account. I'm not selling contracts at all. I hope to get a big enough account one day where I can maybe sell some covered calls or cash secured puts, something along those lines. It would be very interesting to try those things. But as of right now, I don't have that kind of money, and selling contracts, you can literally lose infinite amounts of money by selling contracts. So I'm not keen on that just yet. Okay, so going back to our straddle strategy. So our stock is trading, say, at $100. I buy a call at $100. I buy a put at $100. Okay. The way you're supposed to do this is when you buy these contracts, you're supposed to buy them at least 90 days out to expiration. Okay, these contracts are gonna be looking to hold for a significant period of time. And if you followed the Tasty Trade guys, their rule of thumb is that you're actually closing this straddle position 21 days before expiration. That's how long you can hold it up to, and that's where you exit. You're going to take profit, okay? So this is really how this is supposed to work. And the reason you do this is because you may have some sort of news event coming up that you don't know how the market's going to react to, but you think the market's going to react in a big way. And you don't know which direction it's going to go. This can be very, very beneficial, especially because if whatever this catalyst is sets in some type of trend for the market. Where you can do very, very well with this is that, 90 days out, you might spend $2,000 per contract, and very quickly be $10 to $20 in the money for one side of that option structure. And basically the one side will pay for the other side plus make you your profit. So this is really the idea behind it. It's the strategy behind it. It's defensive. The ultimate idea, and that's, and then when you close it, especially closing 21 days, there should be some premium left in your option, in your losing leg of your options. But all your profit should be in the winning leg, okay? And you should, and there are guys who trade this and they do very, very well. Again, it's a very expensive strategy to do this. It is low maintenance relatively, but it is expensive in that the premiums in there, you're at least $4,000 to $5,000 trading just one to one on that sort of strategy. The other strategy that is out there, and it's a similar sort of thing, you're buying 90 days out, you're closing 21 days to expiration, is the strangle. And the strangle is more, it's more geared, more targeted. And what you're going to do is you're looking out of the money on these. You're not looking in the money or at the money, you're looking out of the money, where you're buying a call. So let's say our stock is trading at $100. You might buy the 101 call and the $99 put, okay? So you might have this as your strategy, right? A little less premium intensive, getting options that are a little less out of the money. You can go a little further out, so it's a little wider out. But what you really get with this strategy, both of these strategies, is you get the event of not worrying so much about theta decay or about time decay. As our options decay, we lose money to that decay. The less time you have to exercise an option, the less valuable it is. Okay, so these are the two strategies that I was using, and here's where I really messed up with them, and where I really hurt myself is that, one, I robbed myself of any chance of balancing or being rid of theta decay. Okay. One of the things markets are really good at doing is eating the value of your options through eating time off the clock, okay? Consolidation, if you are a penny stock trader, may look really good into some sort of support or into some sort of resistance levels for longing and shorting, and you might be fine if you're just buying shares. But in the world of options, this is a slow death. Okay, the consolidation is a bad place to be. So, and especially if you're playing contracts that theta is burning very rapidly, very close to expiration. If you're in 1 week, or if you're in 3 days, or if you're doing where I was playing the 0 days to expiration contracts. I would come in on the day at the open. I would put on my straddle position, and then it would go one direction, and I'd be doing fine. And then what I would do is, instead of taking profit, I would just absolve myself to hold as much as I possibly could on that winning leg, and I never would take the profit, because what I'm trying to catch is a move in a trend where we generally move in one direction. Okay. And we'll go to the chart here shortly, and I will show you where these places are. So this is, and continuously for strangle and straddle both, this is what happened to me. I would come in, I would take my position, my strangle or my straddle, the market would go down, and then it would come back up, and all of that move, even though I could have been profitable here, it ate theta off of my contract throughout the day, especially because I typically was playing 0 days to expiration. I had some. If you remember going back, my biggest win was actually on one of these where I was straddling the 400, and I paid for the call that I had that wound up worthless. And as a matter of fact, when I sold the call, it had lost money, but it had come back enough that I even made more money. Keeping more of that money raised the value of my account. So I was really kind of hoping that this sort of thing would happen or would process. So we had that big sell-off that happened. You get into November or kind of late into October, right? Before the real rip started to happen. Again, I'll show you on the charts where these things happened. And as you get in close to, okay, we're going to pause right here. Okay, we're going to talk something. Part of my problem as a trader isn't really about knowing what to do. Okay, I know what a good setup looks like, right? And this is something that I have been completely delusional about as a trader, is knowing what to do. I know what to do. The problem is knowing what to do and knowing when to do it are a little bit different, because really there's a caveat here, and that's knowing when not to do it. Okay, so if you don't like the Bollinger Bands, and I talk about Bollinger Bands, I use them a lot. Okay, I use them, yes, as price targets. That is something I like to do. I use them typically on a 10, 15, 5, 10, 15, and 30-minute time frames. I'm typically not using them on less than 5 minutes, and I'm typically not using them above. There are a few times, and I'm really not, like, and if I get into longer time frames, 1 to 4 hours, and dailies, I'm usually not using them as a price target. I'm usually using them as either something tells me not to do something. When I get to a lower Bollinger Band, I know to stop shorting. Okay, I know to be very careful there. Stop trading. I know that when we get to the lower Bollinger Band, we're getting into oversold conditions, and that I'm probably going to see a short covering rally coming very, very soon. I have been caught in those short covering rallies. I have been screwed by not paying attention to the lower Bollinger Band, especially on things like the daily time frame. And yes, I agree that, it can cling to the band, it can continue to fall, it can continue to go. But for me, what I have learned is that is bad news, and you're better off to let that, you don't need that money, because in the long run, it's gonna hurt me, and it always has, okay? So a lot of the reason why I use the Bollinger Bands is because it tells me what not to do, okay? You get to the lower Bollinger Band, you're in a trending down market, and all of a sudden, stop going short, right? Take money off the table if you have it, but stop shorting. This is a bad place to begin shorting from, okay? The other thing that I use is the slow stochastic and the 18. And again, it's the same thing with the upper Bollinger Band, by the way. When you get to the upper Bollinger Band, it's time to stop buying calls, okay? You know that you're overbought. You know that the correction to the other direction is going to happen. And I'm definitely not good enough to time to scalp off the correction usually. So when you get into these places, it's usually for me not a good place to be. And even furthermore, what I experienced with my $1,000 was I began trying to, I kept trying to catch the short covering rally, but I didn't know when it was going to happen. And so what would happen there is I would take on my straddle position, and we would go down, and then we would bounce up. Now here's the thing that's really sucks about that: the down leg, when you here you are, your price action, right? You got your two options, okay? The down leg kills your call, right? So even if you come back, you're not going to make as much money on the return to where you purchased the call option from, okay? And at the same time, the coming back up kills your premium and your theta on your put. You just lost all this profit when it came back up, right? So creating these scoops in the market, a market maker can not only keep the money from a call, but they can keep the premium from your put, even though it may be in the money. And this is a lot of what kept happening to me throughout that whole process. But I kept thinking I was going to work, or I'm going to change things, or I would change from a straddle to a strangle, or, I would try and take profit, or I'd wind up taking profit too soon. And then that would lead to other levels of confusion where I missed really good opportunities, really, really massive moves, okay? And you can see here, like this candle right here, this is the curse of my existence, because I knew that was the short covering rally. I knew that was going to be that, and I didn't even capture any of that. I didn't trade that day at all. I just stayed out of it like a freaking boob. And that drives me nuts, right? Thinking about that. And a lot of it was because if you get into these 3 days here before that, you've got, believe it or not, look, yeah, sure, it's trending downward, but you wind up in this sort of chop fest where you wind up with this buying pressure coming in on the end of these candles, and I'm trying to catch really good moves. I'm trying to catch really good wins. As a matter of fact, going through that time was the time that I'm trying to figure out how to average $125 a day with a single contract, which is also another thing that was like a very foolish thing that I was doing. So I've really taken a look at a lot of this stuff. Again, it's not that I think that there's anything wrong with the strangle or straddle possibilities, but you really doing that with 0 days to expiration is a fool's errand. If you're doing that and you're successful, please comment below. I would love to know exactly how you are pulling that off. If you're playing the strangle and the straddle. As far as a day trade situation goes, I have not had success with that. So what have I done really to change this? And pardon me. So what am I doing to change all of this is one, again, so I am right now, the trading I am still using 0 day to expiration, okay? But what I'm doing is I took a very small account, about $100. I've grown it up over $200. So we're doing very well. But the big thing that's really causing this success is identifying when not to trade for me. That is the thing that is working the most is, and when you, again, that's part of the reason when I bring the Bollinger Bands into this, I am studying when not to trade. And when I talk about the idea that like, hey, the market's going to whip around here, I'm not making a prediction other than to saying this may not be a really great trading environment for me, and that's really kind of what I'm thinking. If you have a way to trade this whipsaw type action and you're doing well, please, by all means, enlighten us. Anybody would love to hear that, how it's done. By all means, I'm not the expert here, and obviously from the thing that the losses that I've demonstrated, the point is not to be the expert. The point here is to have the conversation. And the thing is that plagues every losing trader I've met and every losing trader I've talked to is that the winning traders aren't leading the charge. You're not having the discussion. And as a matter of fact, the guys who are winning are usually just mocking the losers. So if that's your game plan, knock that off, or leave my comment section, or leave my live chat, and if you want to have a conversation, if you got a better indicator than the 18-day moving average or the Bollinger Bands, let us know. I'd love to take a look. I'd love to give it a shot. I'd love to see what you're doing that's very successful. But don't just sit in there and shit on me, because I'm doing it wrong. I already know I'm doing it wrong, calm down there, Sherlock. So that's the thing. So anyway, again, coming into this move here, I'm trying to catch the move down, and these candles just burn out my theta, okay? then you get into here where you should be just grabbing anything you can and riding it up, and I missed that. You get the pullback, so you look for the follow through. You know, after such a savage day, my mindset was like, oh, we're going to keep going, and you didn't. It just pulled back into that second day. It was almost a nothing burger, right? And going forward into the rest of this, it just kept being those sort of troubles where I couldn't wrap my head around the context of the market, what I was supposed to do. And I kept using this strangle strategy as like some sort of safeguard against me doing or thinking the wrong thing. And again, the market saw me coming a million miles away, right? They already knew what to do. So, and because of this, also it also trapped me into positions where when I was losing due to the theta decay, I wasn't able to take advantage of other positions. Remember this big old gap up day? Man, wasn't that epic? Wouldn't it have been nice if you had some buying power? You could have held long overnight into that, or at least gone long at the bottom of the gap and just set your stop right there. Wouldn't have that been nice? But at that point, you know, I'm $300 left in my account, and instead of stopping what I'm doing and going like, oh, well, maybe I should stop because I'd made that $500, I'm thinking, well, I can swing it back, right? So it was really, really foolish, and I learned a lot of stuff. And I even learned even more stuff too, because things like you don't just have to pay attention to theta, you got to pay attention to volatility and vega, right? Like those two things, implied volatility is really, really important because, you know, if you go back to the Fed day, right? If you go back to the Fed day, I'm into an options setup and I'm swinging it through. And in the first 30 minutes of the options, I'm up like $100. Whoa, fantastic, right? Doing really, really good. Okay. The press conference ends and it was like somebody flipped a switch and all of my contracts lost like a ton of value just like in a minute, right? And we had a nice bounce up, but those contracts lost like just really a lot, especially for how deep in the money they were. I'm thinking I should be just printing, I'm going to be green. Did not know that they can literally flip a switch, turn that vega off and on, and that affects the delta and it affects the gamma. As a matter of fact, they can almost eliminate the gamma out, right? Your gamma can stay, you'll be at the money and 0.01 on your gamma. So, or at least that's what it seemed like, because I was not compounding anymore at all. So I wound up holding for the next 2 days just to barely break even on those contracts. And again, that was something I didn't know. And so now I've kind of got this whole sort of mindset of like knowing when not to trade. And, you know, you're coming into this really weird end of the year sort of thing where the only thing you really have to look forward to is a recession and high interest rates. So why are investors going to buy this? Why would they rally it up just to have the bears push it back down? You know, and this is the other thing about what we talk about is the market doesn't need predictions, but it needs context, right? We have to talk about the stuff that's acting and moving around the market and around money, you know? And that I think is really important, is knowing that stuff. And not only because it maybe will make us a better trader, maybe it won't. But at the very least, it's honestly it's one thing that makes this whole thing interesting, right? Is knowing how this is behaving and seeing any sort of correlation or anything that's relative to the price action, right? That seems to matter. It validates a lot of things. It also makes us relevant to each other because we all see the same things. We can all understand the same things. This all is part of the culture. It's not just about did you have winning trades or losing trades. There is a culture around the market, around financial systems. And that's one of the things that makes it so difficult is understanding that culture, right? And how that culture actually affects the rest of the world out there. that is important, and it's important to me. And so that's part of the reason why I'm going to do the streams, is because I want to talk about that stuff. You know, it's not all like, did you trade good or did you trade bad? Yeah, going forward, I will tell you, into next year, okay, this is going to become a very technical heavy channel. I'm going to be a lot more technical, a lot less news oriented, a lot more focused on what it takes to be a successful trader. I have my coach. He has got some video, not entirely of this channel just yet, because until I go through that class, I really don't want to I don't really want to give half information, okay, as far as like where I'm at. And a lot of the problems that I think that my viewers are seeing is that I am giving half information. I am jumping out there and saying things that are only halfway true. And I don't want that to be my channel. I'm not Meet Kevin, right? I don't want to be that guy. And not that I hate him or anything like that. He's got his thing that he does, and he's his person. But I'm just not interested in being that guy. I want to be the guy that when I talk about real estate, people are like, why are you talking about real estate? I think you're the stock market guy, right? That would be where I want to be more than anything. So anyway, so again, I hope you can understand a little bit of this. And again, learning when not to trade is basically the biggest and simplest thing I can do. Again, I do shrink it down on the daily time frames to the shorter time frames, and I do trade based on those. And so far, I've been successful in the last couple of weeks. Again, knock on that wood behind me. I'm not going to say I turned a corner. I haven't turned a corner. And to be honest with you, I'm not even really trading in big size or doing anything crazy or have any hopes for my account at this point. As a matter of fact, most of where my focus needs to be and where I'm moving it towards is paper trading. That is going to be the key. First of all, I need statistics. I need to see how often my trades win, how often they lose, and how those indicators line up. That is the ultimate game plan here, is paper trade until I have some sort of statistical model that shows my wins and losses. So anyway, in the meantime, we're going to go over the chart because I want to point out a few things about today that I thought was very, very interesting. Get on to today's candle. And then, yeah, that's good. Go ahead and turn on the MA. And go ahead and turn on the Bollinger Bands. Okay. So, the MA. All right, so here we are. Again, you're oversold into this lower Bollinger Band. You're losing your embedded reading on the slow stochastic, okay? Again, from what I've been taught. Now, again, this method is something that served me well. He doesn't do it like I do. I completely deviated from his teaching. So, again, I would encourage anybody to watch IRA. I would encourage anybody to take the class. I would encourage everybody to not deviate from his class if you're going to take it and do that with it, right? Okay, now the other thing too about IRA's class, IRA's is really focused on futures, area where I think there was a bit of a breakdown and where I was trying to configure the class to fit something, okay? Overall, market context, that's what I want here, okay? So you came into this lower Bollinger Band. Again, this is where I talked about you hugged it coming down here, trapped in the bounce, right? And especially because a lot, and now not that that was really all that over here. I can't see that too much right now, but again, so some of the stuff though that I did want to say is I talked about this inside candle yesterday, and it usually the inside candle points to either a reversal is what I read. The inside candles tend a reversal of the previous candle. And the other thing that somebody told me, I believe it was Mike Schwartz, said that usually it indicates a tightening of the range. We did definitely see a very small range of trading today as far as things go. Again, there is a possibility this is a bear flag forming up there for another leg lower. Again, more or less contextual things to be thinking about. Hey, maybe there is another leg lower coming. Maybe there isn't. I don't know. Don't trade just because somebody says, "Oh, I see a bear flag." That's not a reason to put on a short position. Okay, trust me. For somebody, a year. Listen, I traded stocks, penny stocks. I did very well. Put my account up $6,000 within 6 months. Was doing very, very well. Okay, I did that pretty good. Okay, especially considering the fact that my first 6 months I lost 6,000. So I made back my money plus I made another 6,000. I did very well doing that. I was very excited, but I wanted to scale. I wanted to learn options. I wanted to do these other things because I think there's more money to be made there. And so I basically put myself through this torturous hell of losing money. And I still, to this day, my year-to-date losses are like $4,600. So I'm still making more money than I've lost in the last year, which may seem to be a sick justification, but there it is. Again, so coming into this, okay, you're off the lower Bollinger Band, your momentum's coming up, chances favor a run to the next main moving average. This is something IRA teaches, okay? This is something that we've seen happen, okay? You can see over here you lose it, and instead of coming back to the 18, here you lost it, right back over here, and you came back to the 18. Bounced off the 18, came back up, started to lose it, and then you begin to pin yourself between the 100-day moving average and overbought, right? That's how I kind of stayed there. Now this is another place where I lost a lot of money through all of this because I kept trying to make it back to this 18-day moving average, and where it started trapping everybody was at the 100. Let me see. Well, okay, so I missed most of these moves. That's right. I kept trying to go long off of the 18, and it kept falling through to the 100. That's where that really messed up. Because I was trying to trade into the trend. I kept going long, and it would fall all the way back to the 100, and then it would throw itself up. And by the time it did that, my theta was burned, right? And so by the time we get to this day, where I should be just riding the monster wave up and making tons of money, the amount of money I got left is nothing. I'm burnt, right? So again, a lot of this is learning when not to trade. I could have ignored all of this, waited for this move, for confirmation of this move to start to happen, and I could have rode that. Would have been very easily, especially given the Powell catalyst that was on that candle. So, but again, none of that really matters, and it is a little bit hard to tell what trades I took based off of the daily and where I screwed them up. So, and I do struggle to find ways to illustrate the exact trades that I took. I would like to be more forthcoming. So I'm going to add a spreadsheet that logs all of that stuff, and you'll be able to see it, and we'll be able to go over and talk to it and have screenshots and things of that nature. So, but that's all coming. So, again, so if you do IRA's and this is IRA's system, right? Your trend is down, your bias is short, your momentum is, you lost the embedded reading, and so unless you go back down into oversold, your hands off. There's no trades here, right? What you're looking for is a break above the 100 to really get long, and you're looking for a break above the 18 to get short, or rejection there. And then the other thing too is that you'll notice is this 18-day is getting ready to come underneath the 100. From what I understand, and again, this is something IRA says, and this is, I believe, because the last time it happened, we put in that low. When this average crosses underneath there, typically you'll go back out and take out that low, okay? Now, I don't know what's going to happen. I'm not saying it's going to happen this week, right? It could take part of January for that to play out. So but that's just, again, stuff that is market context, market culture. That's the things that they talk about. None of this is prediction. You didn't hear me speak any actual number. So it's just a prediction, or it's just commentary on market behavior. And the other thing is you have to know there's a whole bunch of other assholes out there that are talking about this the same exact way. They're going to be trading on this based on that commentary, right? So the idea is to get away from trading based on the commentary and get trading based on what you consider buy and sell signals, okay? And in order to do that, you need to establish what those buy and sell signals are, paper trade it until you have a confirmed, thing where like your signals give you some type of edge in that they win more than they lose, okay? So that's what I'm moving towards. That's the only way I think to battle this. And the big thing again is if you do get the context of where the market is and stuff, it can give you the indication of, hey, maybe today's not a good day to trade, and that's where I'm at with it. So the Russell Journal, written, edited, hosted by me, Russel Liss. We are produced by Social Media Shows. Our executive producer is Pureza. If you are interested in a show with them, they will defend you in the comment section. And until tomorrow, pretend I said some sort of catchphrase.